Good afternoon, ladies and gentlemen. A very warm welcome to you on Business Today Television. The mood on Dalal Street is now getting better and better as each day passes into mid-November. The Nifty rallying for the third day in a row has 25,900 on the board. The bulls are very happy on Dalal Street, and we have lots of strength coming into banking counters on the private banking side, and of course IT going full stream ahead. To discuss this and a lot more, we are now joined by Mr. Satish Ramanathan. He is the Chief Investment Officer at JM Financial Asset Management. Mr. Ramanathan is a veteran of Dalal Street. He spent a considerable amount of time with other AMCs as well as ratings companies, and is now managing somewhere like 12,000 crore rupees at JM Financial AMC. Their flagship fund is the Flexicap scheme that has about 7,000 crore rupees in assets and has a very strong long-term track record. It was earlier known as JM Multi-Cap Fund. With this background, a very warm welcome to you, Satish ji. The markets look in fine shape at this point of time. November is panning out to be a good month. How are you analyzing sentiment in Dalal Street?
Good afternoon, and thanks for having me on the show. The markets are recovering along with the earnings. The corporate earnings are looking better than the previous quarter. Corporate earnings growth is expected to be about 11 to 12%. And what we did in our study is that 15% growth related companies or more constitute 50% of the market cap, which is quite impressive. And as a result, we are quite enthused by the earnings momentum that we see in the corporate world.
Mm-hmm. Fair point. Mr. Ramanathan, we've had a terrible time for the markets as far as the main Nifty is concerned during 2025. What to speak of mid caps and small caps. Given this modest green shoots that you see on third quarter earnings, would you say that the worst is behind us, given the strong macro tailwinds that are blowing across the economy?
So I think we need to break down the performance of the market into two aspects. One is on the valuation aspect, and the second is on the earnings aspect. As regards earnings growth was a little muted for 2-3 quarters, primarily due to the base effect. But the valuations had run ahead of themselves, and we were calling for a market consolidation, along with a slight fall or correction also along the way. And I think we are broadly down to that level where 13 months to 14 months of consolidation has taken place. And from here on, as the earnings picks up, we should be in a better position to get some yield.
Fair point. As a CIO, you manage somewhere like 12,000 crores. How much of fresh money via SIPs is landing into JM's equity funds? How are they getting deployed over sectors? What makes you enthusiastic about these earnings where fresh money can come in?
So we are taking a little more prudent and a balanced approach in our strategy. We are looking at sectors where valuations are reasonable. The earlier gung-ho days of growth at any cost is clearly coming to an end, and we need to be more prudent when allocating capital. So we are taking a balanced view of growth versus capital and the valuation, and then allocating accordingly. And what we also have, our monthly SIP book is greater than 100 crores. In fact, at a peak, it had touched more than 120 crores. It's currently around that level. And we believe that the SIP allows the investor to average and build a strong, meaningful portfolio in a over a time frame.
Fair point. So about 100 crores of fresh funds are pouring into the AMC on a monthly basis. given the valuation matrix, Satish ji, where do you find maybe a longer runway to growth? Where do you see these 100 crore rupees finding better quality and stronger earnings stocks?
So there are two aspects that we need to factor in. One is the liquidity premium that large caps offer, and second is the earnings momentum that mid caps offer. So what we are doing is taking a balanced view and allocating it across the large and mid cap space
Okay.
to capitalize on this. And if you see our top holdings, predominantly it is across large and mid cap stocks. And the small cap, we typically have lower allocation to exploit the superior growth that we may witness in some of them.
Okay, I think it's quite after quite a while that we see this constellation of good returns coming from the large cap space. L&T at a record high, Bharti doing very well. Mahindra and Mahindra, of course, has been a leader for the last 5 years as far as the Nifty is concerned. So the going seems to be good, at least on mega caps. Would you agree?
Yes, I think mega caps offer reasonable value, safety, as well as stability of earnings and moderate growth as well. Some of the stocks also offer superior growth.
Okay, fair point. Now let's look at your flagship scheme, which is the JM Flexi-cap fund. It was earlier called the multi-cap fund. About 6,000 crores is what this scheme manages. About 55% of the overall AUM that JM AMC has. Mr. Ramanathan, I'll get two questions out of the way before we get into the detailed examination of your portfolio. The 1 year return for JM Flexicap fund hasn't been anything to talk about, especially compared with larger peers such as HDFC Flexicap, as also Parag Parikh Flexicap. What do you think has gone wrong in the last 12 months and what are you doing to rectify it?
So we were having a slightly higher allocation to the SMID category as compared to our peers. One, and what we also witnessed is the liquidity quickly drying up in this category of stocks. And what we have done is we have moved away from the SMID to having a more balanced portfolio of large, mid, and small cap stocks. Currently, our large cap allocation is about 52 to 53%, and the mid cap and small cap are the other aspect. Further, as a fund house, our philosophy to keep cash at high levels is not there. We typically deploy almost all of our cash, and our cash levels are typically used for rotating the portfolio rather than keeping it as a defensive hedge.
Okay. So, by what time do you feel this 1 year lag that JM has? By the way, 5 year and 3 year returns of all FlexiCap funds are almost in sync. It's this 12-month downtick that JM FlexiCap is undergoing. How much time, Mr. Ramanathan, when your unit holders would be in the same breath as maybe the other larger pairs?
I think we are working on it. It's work in progress, and we should see gradual improvement coming through from time to time. But needless to say, navigating the volatility of the markets is a challenge, and we hope that this restructuring that we have done into the portfolio should help it in good stead.
Was this restructuring the only reason why you have a very high portfolio turnover of about 160% versus 14-17% that we see in other FlexiCap funds? Is this one off?
Our Flexicap fund has typically got an active strategy of moving across sectors, across cap curves, and consequently the churn rates in our Flexicap fund is typically higher than our peers. It may have served some benefit in the past, but probably now, given where the market volatility is, our peers seem to have scored a point.
Fair point. I mean, ups and downs are a part of the market. You win some and then you don't win the rest. It's okay. I mean, we've seen many cycles over the last 30 years, and it's understandable that such changes happen over time. I'm sure you'll set the record straight over the next 15, 18 months or so, and Flexicap scheme will catch up with the very best that there is in the market. It's an unusual portfolio, Satish ji. The second largest counter has done amazingly well for you, which is Godfrey Phillips. The stock doing phenomenally well over the last 1 year or so. Any specific reason why this FMCG company has such a high weightage on your stock portfolio?
So this is a typical fund house stock, and it exemplifies what JM stands for. Bottom-up ideas with high conviction bets, which where our research actually works on it and brings out the idea. And Godfrey Phillips was one such idea where we found that this company was growing well into double digits, primarily because of its relationship with Marlboro, Philip Morris, and it was gaining market share. And its joint venture with Philip Morris was doing very well. And we could see the numbers trickling in, and we interacted with distributors, dealers, kicked the tires, went down to the shop level, understood their philosophy, and then took a high conviction bet across almost all of our portfolios.
Okay. The weightage for financials at JM Flexicap fund is slightly on the higher side. Would you explain the logic as to why financials, both on the NBFC space and the private banking space, attract you as much?
Right. So our thought process in financials was that it has a high contribution to the Sensex and the index profits, and that profits, those profits are valued at reasonable levels compared to some of the other sectors too. And third is that the balance sheet is in a fairly pristine shape across all financial companies. And fourth, we expect growth to return, even though there was a bit of a NIM compression. So based on that, we took a slightly higher allocation. The other aspect of our financial allocation is that it's a combination of two, three aspects. One is the traditional banks, and second is that we also have allocation to wealth companies and to stockbroking
Yes.
firms. So that is a shift that we see in Indian savings habit, and we have an allocation to that as well, which differentiates the portfolio.
The fund, the stocks that are in the top portfolio, the top 10 stocks within the portfolio that reflect this are HDB Financials that got recently listed, of course Motilal Oswal Financial Securities, and from the internet space you have Paytm as well as Eternal, earlier known as Zomato. Mr. Ramanathan, given the kind of valuations that we see in the internet space, are you comfortable holding these stocks for the longer term? What is the normal investor, the retail investor, missing in terms of not being able to maybe analyze the long term, the potential of long term performance in companies such as Amber, Eternal, Paytm? These are mostly institutional stocks.
Yes. So while we do not discuss stock specific ideas, what we do highlight is that there's a long runway of growth in many of these segments, whether it be quick commerce, whether it be the EMS space, or whether it be online payment transactions, etc. So the way the traditional banking system is changing is significant, and the pace of change is also mind-boggling. So therefore, I think it is necessary to have a portfolio allocation to these kind of changes that is happening in the economy, and we also balance it out with the more traditional banks and financial services to uh, cover the volatility aspect of these portfolio.
Okay, fair point. I see an interesting stock from the small finance banking space, which is Ujjivan. Do you think that the liquidity in the market, especially in the lending market, is now enough to get these small finance banks out of the morass that they are in? Typically, this is the last leg of the rally when small finance banks begin to move.
Right, small finance banks cater to a different segment of the population, typically unreached by the larger banks. They do take a higher proportion of risk, but they also grow at a faster pace than many of the traditional banks. So it is necessary to balance the portfolio and keep a smaller allocation, albeit allocation nevertheless, to this segment of the market.
Okay, fair point. What about the defense space? Yeah, you wanted to add something, Mr. Ramanathan.
Yes, sorry for that. I also, in terms of the stress in the small finance banks, which you had alluded to, I think we are probably behind the worst. A lot of the strictures and the guardrails that were passed have already been implemented, and the pain also passed through the P&L and balance sheet. So consequently, I think we have probably passed peak pain, and we should start seeing growth and profits resume.
Okay, fair point. The other issue I wanted you to perhaps offer your view was on the way India's macro has shaped up over the last 5 6 months or so. We've had cuts in the GST rate, in income tax rates, interest rate costs have gone down, liquidity has shaped up for the better for the broader economy. How is the macro balance sheet looking to you? Do you think that will help funds such as you over the next 18 to 24 months?
I think the macro balance sheet is in a perfect shape. It's pretty healthy, as also corporate balance sheets. It was the personal balance sheet that was taking a bit of a knock, which is actually recovering and changing quite dramatically. So, as regards financial health, I would say that India is in a fine shape and there's nothing to worry about. What we actually worry about is that are we pushing the pedal fast enough to grow at our peak capacity, or is something holding back the growth? And I think that probably more aggression is required, both from the government infra side as well as the private corporate capex, to kind of kickstart the economy into the next higher growth trajectory.
Satish ji, this absence of a trade deal and these punitive sanctions that we have on our economy via the US, are they a nitpick for fund managers such as you? Do you find a discomfort looking at sectors that are impacted negatively by them?
I think, to be fair, some sectors have been left out. Some sectors have been impacted nevertheless. But I think this trade treaty and trade issues that have cropped up have just highlighted the risk that our economy faces by being overly reliant on one aspect of the economy or one region of exports, and it is necessary to diversify. So I think the message that has come across by this action is to have a diversified export basket and companies that are catering to multiple regions rather than one particular region excessively. And what I have noticed with my interaction with corporates is that many of these companies are quickly diversifying their export basket across regions, and that's a key positive. So probably after 6 months or 12 months, we would see our companies in a much better shape on the export side.
Satishji, one issue that has, sort of disturbed or completely put fund managers on the back foot is this very strong rally in gold and silver. Both precious metals have given 48 and 52% return respectively year to date. Is this sustainable? And if yes, what are equity fund managers doing to balance their equity portfolios?
I think gold and silver as commodities have performed very well, primarily because of the geopolitical risks that have surfaced and central banks building up their gold reserves. And this trend may continue for some more time because global trade has been disrupted. Because of US trade actions, and B, because of the regional wars that we have seen. That said, I think the fact is that most of the gold rally in gold has taken place for this year, and maybe we should see muted returns for a couple of more months before the next leg or next rally starts. Gold will continue to perform reasonably well as long as central banks support it and build it into their reserves. One of the reasons why gold fell also was because central banks were selling continuously. The demand in India and China for physical gold ownership at the retail level is also very strong, and this will continue to grow and as a trend, and therefore gold will be supported in pricing for some time to come.
Okay. What would you see as a fair price of gold over the next 18 months?
It's beyond my forecasting capability, but having said that, I think there could be a little bit of a pullback because it's been a fairly sharp and fast rally that we have seen on the basis of certain speculative and investment decisions as well.
Yeah.
And as they pull back, you could see a little bit of fall in gold prices also. It's fair to assume that, but structurally it could be still a positive trend.
Satishji, now you are being modest. I think you should step forward and give us a target on gold at least. We are not asking you on equities कि SBI कैसा लगता है, निफ्टी कहाँ जा रहा है. गोल्ड के बारे में तो आप बता ही सकते हैं.
No, we are bound by regulations, Satish.
Okay, not an issue. What has been the biggest learning over the last 12 months? What could have gone better for JM Financial AMC? What could have gone worse?
I think on the second question first, what we did do reasonably well was in our stock picking capability. I think we have picked up winners and we have continued to deliver on stock selection, which has been our strength, driven by both bottom up and top down strategies. What could have done better is actually move a little bit away from some of the expensive sectors which have been a little more volatile and put it to a more passive or larger stocks which were more reasonably priced.
Okay, for the next 12 months or so, sir, what is the prognosis of the economy in terms of GDP growth, and where would you see maybe indices 1 year from now?
So I think what we anticipate is a gradual pickup in the economic growth, and if a trade treaty comes through, it will definitely help in sustaining this growth rally. both from the stock market side as well as corporate performance. And it is reasonable to expect at least a 10 to 15% capital appreciation on an annual basis over the next 2 to 3 years. That said, we also have to be cognizant that the valuations are not cheap. So we will probably mirror earnings growth as the key trend for capital appreciation also.
Would you hand out any hope for mid cap and small cap stockholders as well as fund holders?
So mid caps typically have continued to deliver superior performance. Their earnings growth is the fastest in the entire category. And they continue to deliver superior growth. Their balance sheets are very clean and good, pristine actually. And consequently, mid caps is definitely necessary to be allocated in a portfolio to have the benefit of growth. Small caps, one has to be extremely selective because it's a little more volatile. A, because the stock prices are volatile, and B, the performance also a little more volatile because they are smaller companies and more vulnerable to economic shocks. But that said, I think they are also doing well. I think the lesson that we have learned over the past 5 years is corporate India has restructured and restructured how? In terms of the overall debt to equity at 32%, 0.32 times, corporate India has never been so healthy. So I think we have to give a proper allocation across large, mid, and small to get the benefit of superior growth in the economy.
Okay, this would lead to my next question. What would be the current allocation for large, mids, and smalls for a portfolio that starts today in mutual funds and has a disposable, wants to invest 10 lakh rupees?
So the current profit pool of the BSE 500 is biased towards large caps. It's about 65% towards large caps. And I would think a similar allocation would kind of reduce the volatility in profits. For a little more aggressive investor, having a 5 to 10% higher allocation in mid caps would probably drive a better capital appreciation over the medium term.
Right, Satishji, time is of the essence and yours is more precious than mine. We'll call it a day here, but for this very calm, collected and composed thought process, thank you so much. We look forward to an improved performance from JM Flexicap Fund and of course your presence several times over the next 12 months to decipher the markets for our viewers. Thank you for your time.
Thank you so much, Mr. Partner.
That, ladies and gentlemen, was Satish Ramanathan, Chief Investment Officer at JM Financial Asset Management Company. Please continue watching news on Business Today Television. The markets are in top shape. 25,900 is where the bulls are battling the bears on Dalal Street. More good news to follow.
A massive explosion in the heart of Old Delhi has shaken the nation to its core. Prime Minister Narendra